Hey, what's up, guys? It's Roy Spencer here with Roy's podcast. I guess we're doing a little bit of a live stream today. We haven't been able to get to a podcast in a while, but I wanted to keep you guys up to date with what's going on in the market. If you guys have been following in, which I'm sure you guys have, you guys have been seeing the market do some strange things over the last few days, and I just kind of want to touch base on what I'm seeing here and hopefully guide the way for you guys on what we're doing in the next few days and throughout the rest of the year. So, getting it going here, starting it off, we're going to look at the Finviz stock screener, which I want to share with you guys just because it's such a great resource. If you go to finviz.com, really just finviz.com, it'll take you to something that looks like this. Great tool. It puts everything you need to know into one place. We've got the Dow, we've got the NASDAQ, S&P 500, and we're going to cruise over to the heat map in a little bit. You also see your top gainers on the day, and you also see tickers, news, and impact screeners. Just a really, really good tool in general. And I encourage you guys to check this out a little bit. So we're doing a live stream today, which includes interaction. If you guys want, feel free to comment at any time. I'd love your guys' comments on anything that we're doing in here. We're doing it for the fans, and hope you guys find this beneficial. But right, so back to this screen, we're going to click into the heat map, as I talked about before. We've been to this before. I'm sure if you guys have been following the podcast, you guys know what we do on here. This is a one-day performance of the entire S&P 500. Lots of these stocks are on the NASDAQ. The biggest ones, which are on the NASDAQ, are the QQQ and the TQQQ, which I will be talking about in a second, are Apple, Microsoft, Google, Amazon. You got Tesla on there, Nvidia on there, and yeah. But over the 1 week, you kind of seen a little bit of pullback here from our bigger names. Apple's been absolutely killing it despite the panic. And for you guys that have been following, I noted this when this was happening over the last few weeks. As we can see in here, Apple has had this. I think this is like a 3-month look at it, but when you look at the Apple or AAPL on the screen there, it shows kind of like a little graph. That is the graph of what Apple's been doing. And lately it's broke out of its consolidated spaces, breaking above the 160 mark. And, I think that this is a good indication of what things doing or could be doing towards the end of the year, especially with some of these major players. But despite that, this is the only thing really holding up right now over the last week. We've had some real, I don't know, menacing times, and I would love to just dive right in with you guys on what we've been talking about with that. So we're going to dive right in and get over to the TQQQ just a second so I can show you guys the breakdown here of what's going on. Oops, I'm not doing ice cream today. But what we are doing is we're taking a pretty big in-depth look here at what the TQQ has been doing. So, as you've seen, great summer, and then this is kind of when we started covering it from around, I don't know, mid-August to about September, and we're following it, and then we heard from Mike Wilson that the entire thing was going to crash. Really just had a slight pullback, to which we told you guys about the 119 level, to where it crashed down to around the 119, 120 level, somewhere around there, and then had picked up with some steam, cruising all the way up to that around the 170 mark, topping out around 173, I think. Yep. And then has had some volatility here. And so the key things that I'm looking at here, I'm going to zoom on in so you guys can see it. Right here, we see that the pink line is the 20-day moving average, which is this. The 50-day moving average is in orange, and 200-day moving average faintly down here is the, I guess, yeah, that's the 200-day moving average. And then this purple and blue thing is just kind of like the tunnel that it's been running through. And the great thing about Finviz, everybody, is that these lines are automatically drawn for you. I guess that was a little bit of like some of the harder things that I encountered when getting into it, like where to draw the lines and stuff like that. These are professionally made, very well done. If you go in and just click on the heat map. Now, if you click away from it and check out stuff like the intraday, weekly, and monthly, you won't have this kind of similar thing. They only draw it for certain things, which is the advanced and the daily. If you guys upgrade to what they say is Finviz Elite, I think you'll get stuff like that. But as of right now, I just think like for the most part, this is pretty good to indicate it. So what we've seen here, head of steam, as we told you guys, from around the 120 mark, cruise up to the 103, took a little bit of profits there. 170 was about the profit point that I'd been looking at, so I took a little bit of profit there. And then we'd seen this like shakiness because we've had many events over the last few days, which have become quite noticeable in and around these areas. And so, what have we seen here? What has been the problem going on that is affecting the Nasdaq or the QQQ? In this case, TQQQ, which is the 3 times multiple of the Nasdaq, and it moves three times up when Nasdaq moves 1% up and 3% down, roughly, when the Nasdaq moves about 1% down. So what we're seeing here is first 2 days we got the Fed, Jerome Powell, he's back. So that is not a surprise. We talked about that in one of our podcasts and what that means. He is, I think, the best choice for what we had, and he got reelected by Biden, which is really nice. He's been in control of the situation since the pandemic, or a little bit before that, actually, starting under the Trump administration, has been leading the path ever since. He's been keeping the interest rates low. Keeping the interest rates low are what drives the economy, actually pushing them down to an all-time low, and buying and releasing out, or buying back like some of the bonds that they had, is what pushes the money into the economy. So the stocks with that, like interest rates being near zero, and the Fed buying back bonds, which is pumping money into the economy, is part of the reason that we see this entire like trend anyways, and is mostly part of our thesis here for like why NASDAQ and these stocks have been pushing to the upside anyways. With that said, they've been buying back and just paying Americans just money, just be alive. I know recently Biden sent out something like $1,400 to every American. I think either last month or a few months before that, he sent out that check, and that's been a consistent thing. So that's stimulus. And I think about this time we've had about 3 or 4 payments around like either $1,000 or $2,000, and so really Americans just have had something around like $5,000 to $6,000 in just free cash because the Fed just prints it and lets it sit there. So this entire rally has been driven by things like that. Coming out of a pandemic, they handled it very well. But now is the time that they're going to have to make some tough decisions. And coming in here, I guess I'll zoom in for you guys a little bit better. But coming in here, we had Powell being elected on one of these days. I can't really discern or tell which days that were, but he got reelected and then came into a speech and said interest rates might have to move up a little higher or quicker than expected to combat like the, I guess, stagflation or deflationary or inflationary purposes going on in this country. Which makes sense because having the interest rates at like near zero is like, it's like driving a semi truck. You get it going and it takes a little bit of time, but once you have it going and your foot's on the gas, like, I mean, you're cruising. So like what we're saying without all that, and what the Fed can do to like move those interest rates is stop buying all these bonds back, which is, and what he said they're going to stop buying periodically, like phase it out, but they're still going to be buying every single time. Like they're still going to be pumping in money. So, I think that might have been a little bit of an overreaction from the market. And as long as interest rates aren't cruising too high, and we should be all good. And what I mean by that is interest rates are like the cost of money. If people already have money, which is indicated by people just getting random checks from the government, which I think are a little excessive by now because this is kind of just founded, in my opinion, just a reason for people to stay at home. and trade, which might be the reason that you guys are following us. And if you are, no hate. We still love you guys, but we want to see you make some dough with this. And so we've had all that money be pumped out to us, and now we're just kind of riding that wave. We pumped out a bunch of debt. It's not great. We need to pay that back eventually, maybe. And interest rates are like the cost of money going back to that. So with everybody having a good amount of money, especially the rich people who are the big drivers of this market have a ton of money. Like they have increased their wealth. Like the pandemic, it sounds funny, but the pandemic was almost a good thing for them. Like their money has exceeded, I think that I saw something like 10 or 20 trillion dollars of wealth has been created since like the pandemic. And that's just because people need stuff like vaccines and shots and stuff like that. That's going to make some billionaire rich. People are going to need technology and chips. That's going to make somebody rich. Like just think about all these ways that these rich people are getting richer. And that comes, I mean, as that goes on, like there's problems with like how much money they have versus like what like the poorer people have, and that gap has been widening over the pandemic, and that's been a little bit of a problem. But side tangent, and I guess getting back to like the main point, saying that the Fed's going to raise rates and stop, buying as much in the future these bonds is, it signals like when it's going to be harder for companies to make money and ensure that their costs are low. Because when cash is free, you can go to the bank, get cash, pay it off. It's free. So you can take out a ton out and pay a ton back, and the cost is a little cheap because the interest rates were near zero. I think what they're targeting now is around 2% or just above that going into 2022 and 2023 or something like that. 2%. I look at this and I see a sell-off. I see a sell-off starting here and then been driving down ever since. 2% is not a big deal. Okay, so like if you're Amazon, you deal with billions of dollars and the interest rates jumped up from like near 0 or 1 to like 2 or 3. Yeah, I mean like maybe that's like a little bit, but like for these companies that are over leveraged on debt, this is going to be a little hurtful. But I think just what we're going to see here is these companies be exposed that have racked up a bunch of debt. So we're kind of going to be looking for in our 2022 stocks is stocks of value, and we'll talk a little bit more about that. Probably do a podcast and definitely be talking about it in the Discord. But I'm just saying right now, 2 to 3%, not the world's biggest deal. So that was our first pull down. Second, we have the Omicron variant. No, this is not a new fraternity on campus. This is what we have going on in the world. This is a new strain of COVID, or the SARS-CoV-19 virus, or whatever you guys want to call it. But that seems to be weighing on the minds of people. And so with this, we see that it kind of reached its 20-day moving average and then bounced off of that. Didn't hold for long because it just was like something where the second news of the Omicron variant and the first person in the United States actually getting it, which is not a surprise. And the variant, although contagious, is not very deadly from what they've seen it. And a lot of the things are saying and pointing now towards if you get a booster shot, that could create enough antibodies in your body to stop that. So what they're also saying is if past that it's not able to stop it, then it is able to at least give it a little bit of resistance, and then past that, if need be, they're going to come out with like another shot that people can get. And these are all subsidized by the government, and no reason that I think a ton of people should worry. I mean, maybe you worry about a little bit about your travel plans in the future because that's not going to be great for it, but it shouldn't be causing such a big turnaround here in this market. And so what we're seeing here is we're seeing these technology stocks which are leveraged, meaning they have some debt, and then COVID coming out, which probably shouldn't be as big of a problem for technology because that's designed around being better than like COVID and stuff like that, and it's actually been helpful in helping us return to our lives in a way that prevents us from getting COVID and stuff like that. So these sell-offs in the last few days are, I think, big overreactions. And so with that being said, I want to show you guys where I think I'm setting up. I am setting up, this is the 50-day, which is probably going to continue to move higher for a little bit until either these candles touch it, and then I'm thinking we'll see a bounce off there. Another big bounce off thing here is developed by this recent high, and we talk about relative max and mins. That recent high right there should be a pretty good bounce off point for people that are in it. So I see we've got some people talking about some stuff here. Let's see, we're going to a question right now. Let's see what we got going on here. We have a question. Okay, so do you think those will be given by the end of the year? How do you see the TQQ doing by the end of the year? Okay, so right, this is our main thesis here and what we were talking about anyways. So I guess getting back to, like, I might not be making it clear, but what I'm seeing here is that QQQQ, that stuff, fine. We're gonna be okay for the end of the year. I still like think that things are intact, but my thesis could change here if, like, we see these candles blow past the downside here, which is the 50-day moving average, which is around 148, 149 right now. I don't know if we see that because I do think that this relative max holds up. So that's around 152. We could see a bounce, but also the candles have been deceptive. Like, and what I mean by that is a candle reads like this is the high of the day, which is like the little pointy thing to the top. And then this is an indication, if you're reading a red candle, that it moves from here down, and that's what it loses on the day. Or if you're reading a green one, this little thing at the bottom means it's a low of day, and these green means that it started here and closed here. And so what's funny about today is this day is something that saw the TQQQ roughly around noon, cruising past the 170 level. Kind of funny, because you can see it right around here that it was around the 173 level, which has been a consistent selling point. I did not pull the trigger on too many of them because I really thought that it was going to bounce off this 20-day moving average. But, you know, I've been in and out picking up shares, throwing out shares and stuff like that, with the 170 being a benchmark for me. But what ended up happening was this day, right around noon, it was around 173. And then it continued on down past noon to sell off nearly just past 5%, which is indicated right here. That although not sounding too great, I think there's a lot of reasons here for like our thesis into the end of the year for things to be up. I think we get back to around this like 180. I see a lot of reasons for that, and I think a few things that might have pointed to that is Black Friday shopping. Sales were off the charts. People are buying. How do companies make money? Like, for real, like just under a stock price. How do people make money? Well, the companies are making money when people are like buying their products, using their stuff. The line at Apple was out the door when I went to go shopping. So, I mean, does that bode well for Apple? I'd say so. Microsoft, people are still using stuff like that, getting more computers. They're in computers. Xbox, we got the products that they use, like Microsoft Word and all that jazz, which they might have had a deal going on, either one of those days. And places like Amazon, traffic was off the chart. People are still buying because people still have a lot of money. Like, the people that are buying a lot are buying more than they ever have, and the people without as much money, they're not buying as much. But that is as expected because the pandemic did a lot for people that are richer. But that is what drives the stock market. And I mean, like, it's not great, but it's truth with what is going on. And those people are reacting to like more macro trends here. And so I think in the last few days, it's just been a big panic for the selling that's been going on here. But I think it'll be okay. And I mean, going back to what we've seen here in just kind of like the everyday market, which I think this will take us back to the home screen, and I think you guys will see it. But just about everything that saw this peak around 11:30 noonish and just continued to sell off. That was a similar thing in the Dow, Nasdaq, and an S&P 500. So kind of a crazy day, and we can see here that there is more things that were declining, but then advancing today. I mean, it was just a kind of a really crappy day, and I just think where we stand right now is kind of a reckoning period. People, and with what goes on in the market, it being super volatile and stuff like that, we will see times like this. Nobody said that the path forward would be straightforward, and I still think just about what I thought, since what Mike Wilson was telling us, that we needed to sell out. This is not a time to sell out. This is the time to remain patient. We'll see what it does following up with this technical charts. I see no reason to like immediately sell. Omicron virus shouldn't be a detriment to the technology stocks just because they're designed to like handle stuff like that. And I don't think the Fed rates are going to be that big. I think what I could say about the Fed rates is that those going up slightly, marginally and stuff like that, is going to make the growth trajectories of some of these companies not as strong as they once were. But that is not me saying that these companies won't be growing in the future. There's plenty of revenue. There's plenty of reasons out there that they have indications to be growing as they get more customers, as people move and use into their products, as they develop new innovations. These are important things. And I think one of the things that I've been seeing recently that kind of points to like even the smaller kind of side of like the NASDAQ being strong is I'm seeing ads for Adobe now. Adobe's had a lot of money pumped into it, and they have advertisements on TV now. I don't think I've ever seen an Adobe ad before. And I'm kind of wondering like why the marketing campaign, because a lot of people are already using their products. But what people don't know is I think what they're showing on their marketing ads and stuff like that is their cloud power. They're going to be moving over into stuff like that. Like these are developing businesses, and like we can just walk through why some of these names would be like Nvidia, stuff like that. Like although maybe got ahead of itself, people are going to need chips going forward. Chips. I mean, not potato chips, but more so like semiconductor chips and stuff like that. That's in the computers. That's in microwaves. That's in trucks, and these semiconductors and chip makers are big components of that. People want those. In fact, the demand for things like this, going along vehicles routes, those are still on back order. Another good reason that we see stuff like Ford and GM and stuff like that having a boost, because these are underlying reasons for these stocks to be bullish and reasons for stocks to be continuing on the upward trend. I just think the market's having a little bit of an overreaction right now. But we will stay tuned, and I will be doing more live sessions into the future talking about reactions. Data is kind of ever changing, and I will be updating you guys with that. I mean, we got in, if you got in with me in the NASDAQ, we got in around the 119 level. It's at 150. We're still at a profit, people. Like, let's just calm down here. It'll be okay. So, beyond that, that's my spiel for you about what's going on in like the market with like the TQQQ and stuff like that. But I guess more of like a side question that I've been asked to tackle is looking at this company, Texas Roadhouse, right before got on, and like as you guys can recommend to me any stock, I will look at it for you guys, and I'll kind of let you guys know what I'm thinking and like what I think like the best path to this is. So Texas Roadhouse. So what do we have going on here? Texas Roadhouse, and just from like a technical breakdown, this is kind of something that looks like it'll just be staying stagnant. You know, it's not had the greatest run lately, but this is not a stock where I think it should be falling off the face of the earth. So target price here was around 100. These are a little bit deceptive. When was this target price assembled? And so I think we can go down and look at some of these, which is great. And we see October 6th, we have Loop Capital initiating the coverage, saying that this stock could get to $121. So let's just go ahead and see what that did. October 6th. Yeah, no need for an advertisement. So October 6th looks like it's right around somewhere around here. And at that point it was around $93. So going past that, kind of just been on the downward decline. And I think what has been going on is these stocks, which are especially retail based with restaurants and stuff like that, they're being hit considerably a little bit harder on stuff where people talk about news like this, like headline news like the Omicron virus. This is worrisome to investors, but I think like the core investors kind of know what's going on here. But what we see here is like if you had to think about the virus, what's it going to be impacting the most? So what did the virus initially impact the most? Well, we all shut inside and remained doing more technology-based things with using more computers and stuff like that. But we shied away from travel, which, and another stock I'll show you guys is the airplane stocks. Travel, leisure, and outdoor dining, or going out to dine, because, I mean, you don't know, like, if you are cautious and you don't know who's like out there, you could be sitting at a table across from somebody that has a virus or something like that. So these are all just kind of like thoughts that go through investors' minds. And this stock looked like it was prepared to settle upon its, I don't know, right around its like bottomed out period, which I still think they might not have been drawing it exactly right, which I think might have been around the 186 or 185. But this line, this blue line at the bottom is all right. Yeah, it should have been kind of like holding up here around the 186 or at the 86 level. But with this news, like stocks kind of without news kind of trade within their designated patterns. But news, as we can see, which this is kind of a great example for stuff like that, can be derailed from their original trends. So what we saw here, initially Fed interest rates, that's going to hurt. And then following that, we see the virus. So two things back to back derailing it below its current or its current trend. I'm not saying that trend was like, wow, what an amazing uptrend. Like this is not pointed the upward direction, but I don't think that like it's something that you ditch immediately. And I would have cut out or phased out my investments. Especially because this one pays dividend. Yep, pays a dividend of 1.93%. That's the yield, and that is something that would have been making up for holding during a downtrend. You would have still been making that dividend, and dividends, which we will be covering in another section, tax a little differently. They're a little bit more favorable in terms of their tax. You don't get hit with like the capital gains on those. And you get to take that. So that in that sense is like the reason I would have held on to it. This kind of just simply got derailed by what was going on and stuff like that. So I also promised you guys that I was going to look at some airline stocks. This is United Airlines coming up here. Boom. So similar things. What do you know? Crazy. So initially, the month of August is just in terms of seasonality, just a good month overall for airlines, and I've been in a couple of discords where they talk about buying some calls that would have held up and gone pretty well. I mean, somewhat, but I mean these things haven't been able to get to like their prior highs, which is still not like 62. Like I think if we were able to like zoom out a little bit, no quiz for me. And look at their monthly. We'll see that before the pandemic, and you'll see the line kind of be taken away here. Before the pandemic, this thing hit a high of around $100. Still, it's sitting at 39, and I watching an interesting like piece, or listened to an interesting piece today. Is like this is not a horrible investment. Am I in it? I mean, I might have like a few bucks here and there in these airline stocks, but these are hard plays because of these strains that are coming out with the virus. You get a good day, you get another good day, and then all of a sudden, boom, you get news that another virus is coming out and another strain's coming out, and then all of a sudden, you've lost a good amount of your customers. I mean, and the airlines have been plagued by all that. Like, not only were they wrecked by the initial virus, Delta came in. Now we have Omicron. It's kind of hard for these guys to keep up. So my own thoughts on this is there is places that are going to hold up a little bit better, and I think we can find that just from looking at the screener. Oops, not that. But I do encourage you guys to check this out. There is screeners, there's maps, which is the heat map, there's groups, just amazing stuff here. And I was actually checking this out the other day. Not just, you can make it custom, you can look at a performance-based bar charts. I just looked at the charts in general, but like these are by sector. I looked at it by industry. And you can see over the years like what things have been doing. Like, and they make them look very nice too, and they even draw the 50-day moving average through it, so you guys can kind of compare to that. But what we were doing here is we were looking at the maps, and we're kind of looking through like what actually went well today. From the big names, not a lot. We had Ford doing all right, GM doing all right. These are still stocks that have a promising future ahead of them. Like, I think one thing that we need to like discuss, and we've been discussing it a little bit in the Discord, is there's a thing called the Santa Claus rally, and I have an interesting I guess kind of tweet thing that I want to break down for you guys is so, and I put this in the Discord for you guys that are interested. That's where all the best content comes out. So what we have here is we have a tweet here by Ryan Detrick, comma CMT. This guy is one of my favorite analysts on Twitter, and he talks about don't give up on the Santa Claus rally just yet. When the S&P is up greater than 20% for the year going into December, the final month of the year is actually stronger than normal. In fact, 8 out of the 9 past times it has been stronger than usual, meaning we're going to see some green. Okay, like if it's an anomaly, we won't. And I mean, we're seeing stuff that could make an anomaly with Omicron virus. I don't think that's going to last too long. We've been through COVID. We know what to expect out of COVID. So in reality, we have a lot of these factors. We have a lot of these seasonal trends. We have a lot of positive things here. What I think we're seeing right now is some panic selling. And so you do see a lot of red on your screen. I know that's a little scary, especially if you look at the ETFs. I'm not going to sugarcoat it here. TQQQ is one of the worst performing ones out here. So, I mean, it's not great per se, but it's just kind of the roller coaster ride that we're on. I mean, if you guys ride out with us and hold cryptos and stuff like that, I would say like stocks are a little safer than that most of the time. So riding it out with them shouldn't be such a roller coaster, but I do understand if you guys have a decent amount of money in here, that you guys the live session and wanted to like group together here and do a little bit of a huddle so that we can come up with a game plan. Game plan is still to ride on out. If anything changes, I will be doing another live session here going into the future so that you guys can be up to date with what I'm doing. We're going to be on our podcast as well. I think Johnny will be on the next one. And we have a lot of ways to like get around even if the markets are selling off. We have great cryptos to talk to you guys about. We have some plans to, I guess, kind of avoid or check out the inverses of some of these things to get away. There's other countries that we've been looking at. There's a lot of ways to diversify your money. So days like today, even if you have money in the market, it shouldn't be like the end of the world. And I guess kind of with that, I don't see too many other questions. Let's see. Okay, so we actually do have some questions here. So the questions that we're seeing here is oh, okay. I think these are some great points as well. And we have how is China affecting the market? We have HODL. We have top 10 stocks traded amongst retail investors. These must be coming from some of the people that have been checking out the Discord or stuff along those lines. But top 10 stocks traded among retail investors this year. What do you know? Are we on point with what we've been trading this year? I think we might have been at least like some of the people that got in early. Top 10 most checked out stocks by retail investors this year and invested in. Number one, TQQQ. That comes in at number 10 in the rankings. TQQQ. That's a big one that we've been talking about. People are in on it because it's good. We got Moderna. No surprise here. If you have stocks, you know that like Moderna is a public company and you can trade it, and that's not a horrible name to trade on when you think that all these vaccines and mandates are coming out and these companies could be profiting off of that. Year-to-date performance of the Moderna is 102% return. Year-to-date performance of TQQQ is 84% return, which is, yeah, I'd say pretty good. One of the better ETFs. So we still have more to roll through. We have Nvidia year-to-date performance, which is part of the TQQQ, is 132%. That's not bad. The Invesco QQQQ. So that is TQQQ minus a T, meaning you don't get the triple effect. So when stocks are up, you're up according to the NASDAQ, and when they're down according to the NASDAQ. So if you were in the TQ or in the QQQ today, it was down 1.6%, and so you'd be down 1.6%. That is also not a pretty good hold just because it pays a dividend as well. Another stock that people are turning to is NEO. That was one of the first ones that I had ever recommended, but that was back when it was like $10. Now it's like $40. But that is one stock that I've been looking at as well, and I am favorable on that, especially with like the EV markets going into the future and infrastructure spending. Especially with these other kind of companies. NEO is from China, XPEV is from China, and they are building these cars like crazy because they've been working on this stuff hard. And although I'm not a big fan of Chinese companies, if I were to like splurge per se and go in on some Chinese companies, those would be the names that I'd pick. But I still think that there is some good names here in America to pick as well. That's why I've been talking to you guys about Ford and GM. Those are still solid names, and the demand for those cars are real. There are people on back order for like some of their newer EV cars, especially the Bronco. So past that, we have the Spider S&P 500 Trust, SPY. That's just a classic. AMD, that's been up this year 58%. That is another classic stock that has been performing pretty well as well. If you guys don't know what they are, we don't really cover them on here. I haven't really been on them this year just because like I found other opportunities to outpace them. But they are up 58%, and they are in the chip making business. So we have NVIDIA and AMD's, both in the chip making and semiconductor business. Big technology. So where does that put us? More of the technology side. We have AMC. That's number 3. Classic. Apple, number 2. This year has been up 14%. It's kind of the main driver of stuff like the QQQ and the TQQQ. This is, I think, one of the biggest holdings in that makeup of them. Up 14%. If you had the TQQQ, it's more like up around 45%, 46%. And the number 1 is Tesla. Now that this year has been killing it, up 48%. That is one of the reasons that I talked to you guys about when it was about to pop off right before it got to the 1,000 mark. It was just kind of inevitable. Like, so many retail investors flock to this one, and when there's a move being made, so many options contracts are being thrown through stuff like that. It was almost inevitable, and that's how that stock trades. And that stock can continue to do stuff like that. So that's going to be a name that I continue to watch into the future. Not saying that I own it outright, but it's a good stock to like be paying attention to for option trades. I guess, how is China affecting the market? Just going to have a little bit of a quick answer on that. China is a very big competitor of the United States. They're past us in GDP, a little worrisome, but I'm not entirely worried. They're just going to be a big competitor of us. I'm not saying that I'm going to buy too many of their stocks, and in fact, I stay away from most of their stocks just because you never really know what their President Xi can do with recommending, or when they say like, this guy's done. Well, just like Jack Ma, they're going to find themselves on a vacation, very long vacation. And so, I mean, just as an investor, just because their market is not a capital market, like that's just the biggest reason that I stay away from stuff like that. So, although China stocks might be profitable in the future, I'm just not able to like kind of take that risk on and feel comfortable in it to like return to like stuff like the money that I have and to like people that I work with on stuff like this. So I'll be staying away from that for the time being, but they are a big driver in the market, and they are pushing the United States to like develop technology and stuff like that. Another reason to be in technology, because I think that's where the race will be in the future, which is going to be, I think, China and the United States really ramping up technology to try to outdo each other and stuff like that. And then I guess kind of just rounding it out here, what is the top individual stock that I am my top individual stock pick for the year, or maybe next year. I guess I'll kind of like share some of them. I was going to do a little bit of just like my own individual AMA or Discord on that, or I mean live session on that. But some of my top picks for next year are things like the TQQQ, but I won't be as heavily invested in that as I was this year. We've got stocks that are going into that. So the reason I'm getting away from TQQQ is just because I think that these stocks aren't going to have as great of a year, and since these stocks pay out a dividend, it would be beneficial to like collect the dividend, which you don't get to do in the TQQQ. So getting rid of that position and getting stocks more like the Master, Google, that is a solid pick. Microsoft, that is a solid pick. Like, we're not reinventing the wheel here. We're just staying with quality. QQQ to get that dividend. We've got, and I think we've got another one. LIT is the Global Lithium Battery Tech ETF. I like that a lot. It's kind of the same technology. Like, technology will be growing. Batteries going into technology have to be like be supplied from somewhere. And this is the like lithium and battery tech ETF. So these are the people that are mining that. Demand is going to be going up, so supply is going to either have to catch up with that at some point to like meet that demand, or there will be new people entering the market, which is good for the ETF because they'll just, I mean, like they have a good composition of like stocks and companies that are in that. So that should be pretty good. And then I think last one I want to share with you guys is about And this is one that I saw kind of recently, which has not been doing so well, but what has in this kind of downturn for like the last few days is a company called Starbulk, SBLK. A quick description: it is engages in the provision of a seaborne transportation solutions in the dry bulk sector. It ships iron ore, coal, grain, fertilizers, and steel products. Yeah, I guess people will be eating next year. Transportation still be off the charts, and I think one thing that separates them that I saw kind of in their like perspectives and stuff like that is they do work with China, so they're gonna have these favorable trade routes and stuff along those lines. It hasn't been doing well over like 3 months, but over a year's time, it's up over 120% favorable on that. I think I'll stay with it for the next year. Analysts are projecting this one out, I think, at around 23 or no, it was around like $30 or something like that. So if you bought it today, which is around $20, and by the end of next year is at $30, you make 50% on that return. I guess with everything being said here today, I am not a financial advisor. I'm just here because I like to talk about stocks, and I like to feel like I am making an impact on what people are doing around me, making good wealth creation and stuff like that. I want to see you guys benefit from the stocks. There's a lot of good money out there. You just gotta learn to be able to tread days like this, because they're not exactly the easiest ones to do. But you grow stronger. I guess one kind of strength is physical strength. The other one, which I think is even harder, is mental strength. And these days teach you to be a little bit mentally strong. But we'll see, and we'll see about what's going forward. Towards the end of the year, I still think things are all right, and I would be keeping you guys in the loop. But until then, this has been Roy Spencer here within, I guess, a live session. Thank you guys for everybody that has been commenting. Very much appreciate what you guys have been talking about. I applaud you guys for getting on here and taking the time to be with me today. I hope that you found some of these thoughts and my walkthroughs of how I'm thinking about the market to be helpful today.